Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. I appreciate you guys joining me. Today, we're just going to go through and look at the comments that people have left recently. Here we go. Dave B asks, is it possible to do a 1035 exchange in later years when the cost of insurance goes up? Maybe to an annuity? Absolutely. So I say definitely there's an option if the growth in the IUL doesn't continue to greatly outpace the expenses. I think that's key. We never want to just consider what is the cost of insurance is inside of a policy. We want to look at that in relation to how is our policy growing? Because if the cost of insurance could be $30,000 in a given year, but if you're making $300,000 or $400,000 or $500,000 in that same year, because of that growth potential and the size of your policy, that expense is a small fraction of it. Those are generally numbers that we look at when we're looking out at around 90 years old. You might have to have a $30,000 expense for $100,000 or $200,000 or $300,000 of insurance. Gosh, that sounds really expensive. Well, yeah, but the reason you have to have that much for an expense is because your policy is like $5 or $10 million in it. And the government requires a certain amount of insurance that the insurance company has at risk. So it's considered life insurance. We have to meet those minimums. So that's just part of the expense of owning that policy. If you've got a $10 million policy and your expense is $30,000, that's like 0.3% of an expense. You could choose to take your money out, do the overloan protection rider, take all that cash out and go invest it somewhere else. Are you going to find a cheaper cost from a percentage standpoint for an investment out there? Possibly. There's some ETFs out there that have or mutual funds that might have like a 0.1% expense, right? But there's no downside protection. There's no death benefit. It could pass on tax-free if you don't cash it out. If you're 90 years old, are you going to go manage that money yourself as well? Probably not. You're going to need to pay a financial person to do that. And they're going to charge you more than that 0.3% most likely. So we have to look at it in context. So yes, it is possible to do 1035 exchanges if the cost of insurance goes up. The downside to it possibly doing a 1035 exchange is you still have to qualify for insurance. So you can't just do a 1035 exchange just because you own the product. You have to be able to qualify for the new product. That usually means you're not really old, and the cost of insurance is probably actually not that expensive. So there's a lot of things I think about when I see that comment, but just know that yes, you can do 1035 exchanges if it doesn't make sense to stay in your current product. So that's generally how I like to look at this. It's not necessarily the cost of insurance going up that might lead you to do a 1035 exchange. More than likely, it's going to be whatever product you bought, that insurance company is limiting your ability to get good growth out of it, or at least growth that you're happy with. Whether it's reduced caps, they may change the bonus options, they might institute other changes in the policy. If you look at the video of mine where I go over all the top IUL products, a lot of those carriers reserve the ability to make changes in that might not be very attractive, and it might limit your ability to get growth. So in those situations, you might consider a 1035 exchange.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.